everyone, welcome to iExamB. Embrace the iExamB learning experience for 50% faster job preparation. Your PFRDA exam for phase 1 is now around the corner on the 6th of September, and for your preparation and last minute revision, in this particular video I'm going to discuss some of the important questions relating to costing. Costing is one of the most important subjects, have covering almost 7 to 8 questions in the exam from this particular topic from the syllabus given. You can expect good conceptual questions being asked from these topics and also a few numericals. So let's start and discuss certain type of numericals that you can expect and some of the most important conceptual questions from these topics. The first question that I'm showing you, have a look, take a screenshot, think about what will be the process of solving this. I will discuss the detailed calculation for this particular topic at the end of the video, right? So take a snapshot and think about how you will proceed to solve this. Meantime, let's discuss other conceptual questions. First question, under marginal costing, which of the following cost will not be attributed to the product cost? Now, when the costs are being calculated, they can either be a product cost or it could be a period cost. Product cost is where it is related to that particular product's production, and period cost is relating to the accounting period or the cost period for which you are accounting for, right? So raw material, freight, labor, rent, or none of the above. The correct answer is rent, because rent is a period cost irrespective of the amount of production that is happening, right? So this is not attributed to the product under marginal costing. Write in the comments which is the type of costing method under which the rent will be or the period costs are also taken as a part of the product cost. Okay. Second question, batch costing will be relevant in which of the following industry? Now, batch costing is a method of costing in which it is used where you are doing batch wise production. So batch wise production can be done in homogeneous product. So according to you, which industry will have a homogeneous product being produced? Infrastructure, construction, cement, architecture, or all of the above, right? Before we discuss the answer, let me tell you about the quick revision course for PFRDA that is valid for your 30 days preparation for this particular exam. It is available at a flat 55% off at 2150. You can check out the demo. We have been guiding for PFRDA and are happy to have been associated with a lot of successful candidates, not just in PFRDA, but various other regulatory bodies like SEBI, RBI, and many such more candidates, and we'll be happy to be associated with your journey too. So let's look at the answer. The answer here is cement industry. You can imagine the cement bags, right? It's a homogeneous product which are produced in bulk in batches. Okay. Next question, which of the following is a correct formula for computing direct materials variance, price variance, right? So here we are seeing what is the difference, why is the difference coming because of the price between what you had budgeted for and what is actually done. So it's a part of your standard costing topic, and the correct answer here is B, actual quantity multiplied by the difference between the actual price and the standard price. The direct material variance can also come because of the quantity used. So write in the comments what do we call that variance, which is because of the difference in the quantity that has been actually used and what was budgeted for. Next question, which of the following is not a form of waste in production process? This is a topic from your lean systems, right? And if the questions from lean systems come, they can be very scoring. It's a theoretical topic, so please do not miss out on this topic. The correct answer here is none of the above. The wastages can happen because of any of these 7 reasons: overproduction, defects, transportation, inventory, waiting, motion, and over processing. Next question, this is one of the simplest type of numericals that you can expect from costing in the exam. From the following information, calculate the PV ratio where you have been given the production, contribution for the production and the sales amount. PV ratio stands for profit volume, right? Here profit is represented by your contribution and volume is represented by your sales. So 40,000 divided by 2 lakh is what will give you your contribution. So here your contribution is 20%. Next question, which of the following is a technique of inventory management? The technique of inventory management, these are your inventory valuation methods. This is a lean system method, and your technique for inventory management is given by the ABC analysis, where you categorize your products that you are, when you are making more than one product, into category A, B, and C, symbolizing that 80% of your business comes from 20% of your products or inventory. Next question, Dash is a computer-based system that can create detailed production schedules using real-time data to coordinate the arrival of component materials with machine and labor availability. The correct answer here is MRP, which represents manufacturing resource planning. This coordination helps to remove away wastages in terms of waiting or over processing or waiting in the production line. Next question, what will be the break-even point in units, in unit terms, when the sales price is rupees 40 per unit, fixed cost is 60,000 and PV ratio is 30%. We know BEP we can calculate in rupee terms through fixed cost divided by your PV ratio, right? So this is in the rupee terms. Now when you divide this further by per unit cost sales price, you will get it in the units term, right? So here you have to divide 60,000 by 30% and further divided by rupees 40, which will give you answer as 5,000 units. Next question, which of the following does not appear in cash budget? This is very simple question. Simply, cash budget means all the cash expenses. Now out of this, which is not a cash expense? Rent, electricity, depreciation, taxes paid. So we know depreciation is a non-cash expense and therefore it will not be a part of the cash budget. It will be a part of your overall budget but not the cash budget. It will be, sorry, a part of your P&L but not a part of your cash budget. Last, the question that I had shown you in the beginning, if you have figured out the approach, you will be able to solve majority of the questions related to marginal costing. If not, let's discuss it quickly. We have to calculate the break-even sales. We have been given the data of the cost of 2 years sales and the units that have been sold. Now we know for break-even analysis, we need to know the fixed cost, which has to be divided by the contribution, right? Now this is again fixed cost divided by the sales price minus the variable cost per unit, right? Now sales price, we know that sales are 1 lakh for 10,000 units. That means my sales price is 1 lakh divided by 10,000, which is giving me rupees 10 per unit. So that is my sales price. I already know my fixed cost, sorry, divided by 10 minus variable cost. Now my variable cost. Now variable cost is something that changes with production, right? So I can see with an increase of 2,000 units, my cost has increased by 10,000 rupees. That means my variable cost is 10,000 rupees divided by 2,000, which is rupees 5. So I know my variable cost is rupees 5. Now once I know my variable cost, here I can calculate my total cost is a combination of variable cost plus fixed cost, right? Now my variable cost is what? 10,000 units into 5, which is 50,000 rupees. That means out of this total 80,000, my fixed cost will be 80,000 minus 50,000, which is 30,000. So that's my fixed cost. You can recheck it by putting in the numbers here also. 12,000 into 5, 60,000. 90,000 minus 60,000 is 30,000. So same, fixed cost is 30,000. So now I know 30,000 is my fixed cost, and 30,000 divided by 5 will give you 6,000 units, right? But here break even we are calculating in rupee terms as given in the options. So 6,000 into 10 rupees, because that's my sales price, is giving me 60,000 revenue, right? So that is how you calculate the break even sales when the information for 2 years has been given to you. I hope this has been clear, and you will be able to solve all types of numericals related to break even analysis and marginal costing in your exam. Do download the app for easy access to your courses and free content related to your preparation. If you have any other query, you can write to us at hello@iexambeat.com or call us at 920 552 4028. Wishing you all the best.